I am AI Avatar of CA Ratan Mundra. India's securities market is preparing for one of the most significant legislative reforms in nearly 3 decades. The government has reportedly accepted several important recommendations related to the proposed Securities Markets Code, commonly referred to as the SMC. This new code is expected to transform the regulatory framework governing India's capital markets. The changes are not limited to regulators alone. They will affect stock exchanges, depositories, brokers, listed companies, investment advisors, compliance professionals, legal teams, investors, and market infrastructure institutions. The objective is to create a more efficient, transparent, and technology-driven regulatory ecosystem. As India's financial markets continue to grow rapidly and attract global investment, regulators believe that existing laws need modernization. In this video, we will understand what the Securities Markets Code is, why these changes are being introduced, what recommendations have been accepted, and how organizations can prepare for the future. Whether you are a compliance officer, legal professional, board member, investor, or business leader, these developments deserve your attention because they could reshape how securities markets operate in India. The Securities Markets Code has been designed as a comprehensive law that consolidates multiple securities regulations into a single legislative framework. Currently, India's securities market is governed by various laws enacted at different times. These include the Securities Contracts Regulation Act of 1956, the SEBI Act of 1992, and the Depositories Act of 1996. While these laws have served the market well, the increasing complexity of financial products and technological advancements have created overlaps and regulatory gaps. The proposed code seeks to address these challenges by creating a unified framework. The objective is to reduce ambiguity, improve consistency, strengthen enforcement mechanisms, and simplify compliance requirements. Regulators also want the law to be future-ready and capable of handling emerging areas such as algorithmic trading, digital assets, technology-driven market infrastructure, and cross-border investment activities. By consolidating various provisions under one statute, the government aims to create greater regulatory clarity and improve investor confidence. This reform is expected to become the foundation of India's capital market regulation for the coming decades. Before finalizing the Securities Markets Code, the government initiated an extensive stakeholder consultation process. Market participants from across the securities ecosystem were invited to share their views. This included stock exchanges, depositories, clearing corporations, brokerage firms, compliance professionals, legal experts, investor associations, and regulatory institutions. The response was significant. More than 1,000 recommendations were submitted, resulting in over 600 unique suggestions for improvement. These inputs were reviewed by the Department of Economic Affairs as well as the Parliamentary Standing Committee on Finance. The objective was to ensure that the final legislation strikes a balance between effective regulation and practical implementation. Stakeholders highlighted concerns regarding investigation timelines, investor protection mechanisms, appellate procedures, governance oversight, and operational challenges. After detailed discussions, several recommendations were reportedly accepted by the government. These accepted changes are particularly important because they indicate how regulators are responding to industry concerns while maintaining strong oversight of the securities market. Let us now examine the most significant changes one by one. One of the most important changes relates to regulatory investigations. The original draft of the Securities Markets Code proposed that investigations should generally be completed within 180 days. However, stakeholders argued that modern securities investigations are far more complex than they were in the past. Cases today often involve sophisticated insider trading networks, algorithmic trading manipulation, front-running activities, offshore transactions, and digital communication trails spread across multiple jurisdictions. Collecting evidence in such cases requires significant time and coordination. Recognizing these challenges, the government has reportedly agreed to extend the investigation timeline to 365 days. This provides regulators with additional flexibility to conduct thorough investigations without compromising quality. For businesses, this means regulatory inquiries may continue for longer durations. Companies will need stronger document retention policies and better investigation response frameworks. Legal teams may need to support ongoing inquiries for extended periods. While the longer timeline increases compliance obligations, it also allows regulators to build stronger cases and improve enforcement effectiveness. Another major development involves the powers granted to depositories. Depositories play a critical role in maintaining ownership records and facilitating securities settlements. Under the proposed changes, depositories may receive enhanced authority to rectify records affected by fraud, forgery, coercion, technical failures, or processing errors. This is a significant step towards strengthening investor protection. In the past, investors sometimes faced lengthy legal disputes when ownership records were incorrectly updated or manipulated. The proposed framework seeks to enable faster correction of genuine errors. For example, if shares are transferred using forged documents or unauthorized instructions, the depository may have greater authority to investigate and rectify the records. This could significantly reduce litigation and restore investor rights more quickly. However, these powers also require stronger governance systems within depositories. Enhanced verification procedures, fraud detection controls, internal audits, and dispute resolution frameworks will become essential. Overall, the change is expected to improve trust in market infrastructure and provide greater confidence to investors participating in India's securities markets. The government has also reportedly accepted recommendations regarding appellate rights under the Securities Markets Code. Orders passed by adjudicating officers would be appealable before the Securities Appellate Tribunal, commonly known as SAT. This change reinforces procedural fairness and strengthens legal safeguards available to regulated entities. The availability of an appellate forum ensures that businesses and market participants have an opportunity to challenge regulatory decisions through an established legal process. This creates greater accountability and transparency within the enforcement framework. For compliance teams and legal departments, documentation becomes even more important. Every regulatory submission, investigation response, internal approval, and compliance record could become critical evidence during appellate proceedings. Organizations will need to maintain detailed records and ensure that regulatory interactions are properly documented. The existence of a structured appeal mechanism helps balance regulatory authority with due process rights, thereby improving confidence in the overall securities regulation system. Another accepted recommendation concerns delayed appeals. Under the revised framework, a maximum outer limit may be prescribed for condoning delays in filing appeals. Although this may appear to be a procedural change, its practical implications are substantial. Defined timelines reduce uncertainty and encourage timely dispute resolution. For organizations, this means stronger internal controls around regulatory communication will become essential. Companies will need systems to monitor orders, track deadlines, and manage litigation calendars effectively. Missing an appeal deadline could permanently eliminate the opportunity to challenge a regulatory decision. Compliance officers, legal teams, and senior management must therefore coordinate closely whenever regulatory notices or enforcement orders are received. Automated compliance monitoring systems and centralized litigation management tools may become increasingly valuable. By establishing clearer timelines, the government aims to create greater predictability in the legal process, while reducing prolonged uncertainty for both regulators and market participants. The Securities Markets Code also clarifies governance oversight for market infrastructure institutions, commonly known as MIIs. These institutions include stock exchanges, depositories, and clearing corporations that form the backbone of India's capital markets. The government has reportedly clarified that the power to supersede governing boards will remain with the central government, although such action will be based on recommendations made by SEBI. This creates a dual-layer governance structure. SEBI evaluates the situation while the government makes the final decision. The clarification strengthens accountability and introduces an additional level of oversight. For board members and senior executives, this development highlights the importance of governance excellence. Effective risk management, strong compliance culture, proactive regulatory engagement, and transparent decision-making will become increasingly important. Institutions that fail to maintain acceptable governance standards may face significant regulatory consequences. Therefore, governance is no longer merely a compliance requirement, it is becoming a strategic necessity. Although many of the accepted recommendations appear procedural, their practical impact extends across the entire securities ecosystem. Regulators gain greater flexibility and stronger enforcement capabilities. Market intermediaries face higher expectations regarding documentation, record keeping, and governance standards. Boards of directors will be expected to provide stronger oversight and greater accountability. Investors stand to benefit from improved protection mechanisms, enhanced dispute resolution processes, and stronger market integrity. Organizations should begin assessing the implications immediately rather than waiting for the final law to be enacted. Compliance functions should review investigation response procedures and record retention frameworks. Legal teams should evaluate litigation management processes. Risk management departments should reassess governance controls and reporting structures. Technology teams may also need to support compliance modernization initiatives. Businesses that prepare early will be better positioned to adapt smoothly once the new framework becomes operational. The Securities Markets Code represents a landmark reform for India's capital markets. The government's acceptance of key stakeholder recommendations demonstrates an effort to create a balanced framework that supports both regulatory effectiveness and operational practicality. Organizations should now focus on a structured implementation strategy. First, closely monitor future legislative developments and review the final text when released. Second, conduct gap assessments to identify effective policies, procedures, and governance frameworks. Third, establish implementation teams involving legal, compliance, risk, technology, and business stakeholders. Fourth, update internal controls, train employees, and strengthen reporting mechanisms. Finally, conduct audits and readiness reviews to validate preparedness. The organizations that begin planning today will be better equipped to navigate tomorrow's regulatory environment. India's capital markets are entering a new era of regulation, governance, and investor protection. Understanding these changes early and preparing proactively will be the key to long-term compliance success. Thank you for watching and stay connected for more updates on regulatory developments shaping India's financial and business landscape. Moon Sales and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.